This is Group 5 and this is our project about the financial analysis of Walmart. One of the biggest contributors to the field of retail industry. They have clear targets for the future. They definitely want to stay ahead in their industry and they want to improve the shopping experience in terms of e-shopping as well as in-store shopping. They certainly want to improve the wages and the working conditions for their worker, as well as benefiting the local communities and the overall environment. So a deeper look at the financial analysis of Walmart's performance during 2018 reveals the following. It wasn't that good of a year, despite what they claim to be an improvement in sales that is approaching 500 billions. However, there are still deficiencies that has to be improved if they want to achieve their previously mentioned goals, because all of them needs money. These parameters have improved this year, including the net sales, which approached a historical level this year, as well as the total assets of the company. But what about the other parameters like profitability and the ability to generate income? Unfortunately, by looking at these graphs, you will immediately notice an increase in the current liabilities of Walmart this year. You will also notice that there has been a drop in the net cash of Walmart compared to 2017, and still the net cash used from investment and those from finance are really less than where they should be. Last but not least, looking at the basic earning per share as well as the dividend per share. Dividend per share has improved since the inception of Walmart. However, unfortunately, the earning per share is decreasing significantly in 2018.
Whether you're an investor, creditor, or on a firm's management team, being able to calculate and interpret a company's financial ratios can provide valuable information. Walmart's financial ratios are intriguing at first glance, so let's dive into the analysis. Walmart's current ratio in 2018 was 0.76, slightly under the industry average, but it appears to be common amongst the industry to have more current liabilities relative to current assets. Usually having a current ratio under 1 implies liquidity problems, but since it's common amongst the industry, I wouldn't suggest Walmart is struggling to pay its debt obligations, especially with the interest coverage ratio of 7.65. Walmart's account receivable turnover ratio is approximately 81, correlating to a day's sales and receivables statistic of 4 days. In other words, this states that Walmart converts its credits in its receivables account into cash every 4 days. Walmart's total asset turnover is quite impressive. The statistic provides insight on Walmart's efficiency in utilizing its assets. The retail giant is able to generate $2.42 in sales for every dollar in asset it possesses. Another financial statistic that is attractive regarding Walmart's financial status is its return on equity. Walmart's return on equity has always been at the top of the industry, reaching approximately 21% in 2014. But during the 2018 fiscal year, Walmart's return on equity took a significant dip, falling to 13%, the lowest it has been in recent years. Return on equity is one of the few measurements that provides good indication on how well management is performing. Based on Walmart's ROE, it appears management has consistently outperformed its competitors, but the significant decline in the most recent year leaves me skeptical in the direction Walmart is heading. Walmart's current weighted average cost of capital, also known as WACC, is approximately 4.61%. Thus, all projects Walmart considers investing in should yield a rate of return higher than 4.61% to satisfy both debt and equity holders. According to Walmart's return on investment capital, the company seems to be exceeding expectations. Walmart is generating higher returns on investment relative to its cost to raise the necessary funds for its investments. Equity represents more than 3/4 of the firm's capital structure relative to debt, indicating that Walmart heavily relies on shareholders to finance its operations. Walmart's cost of equity is approximately 5%. In other words, Walmart investors require a rate of return of 5% or higher to be compensated for their risk. Speaking of risk, Walmart has a beta equivalent to 0.4, indicating Walmart's stock is less volatile when compared to the rest of the market.
How should Walmart proceed financially to achieve its goals? While Walmart may be the world's largest company by revenue, they must continue their focus on growth, increasing their revenue, and staying ahead of the competition that are fighting for the same customers and dollars. Walmart's ability to grow revenue will provide them with the capital to finance future expansion and growth opportunities. In addition to revenue growth, Walmart must continue their focus of decreasing their debt. There was a good progression of debt reduction in the years preceding 2017. They must refocus their efforts toward debt reduction to increase available capital and resources. This will enable them to reinvest in the pursuit of new business ventures, positioning them for greater revenue growth in the future. We believe that Walmart needs to pursue new lines of business that are outside the scope of their traditional operations. They must apply their experience of expansive operations domestically and internationally. They must leverage their successful global supply chain management to industries such as hotels, restaurants, and other service-oriented industries. Due to their sheer size, they're able to manage costs by setting pricing with suppliers that smaller organizations just cannot match. Walmart must make a conscious effort to maintain a balance between growth and profitability. They must continue to be a world leader in their growing retail market while exploring avenues to expand and reinvent themselves in other market opportunities. Not only do we believe that Walmart has the ability to grow and increase their profitability, but to be able to continue to be a world leader, Walmart must, as their competitors are striving to do the same. Thank you.